Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Welcome to the Financial Purpose Podcast. My name is Dale Shafer, host of the podcast. This is episode 90. And we've been, for the past couple of weeks, breaking down each of the steps or each of the letters of the B.O.S.S method, which is the financial planning approach at lifemoveswealth.com. B.O.S.S is a double acronym. It stands for, as a system, it's the Business Owner Strategic Success Method. And in practicality, each of the letters represents a stage of where we're going to be focused on as you move through your business journey. And so we've talked about the B, which is build. We talked about the O, which is optimized. Last week, we talked about the first S, which is secure. And that was a little bit of a longer episode because that is the place where most of the business owners I work with live. They're in kind of that secure phase. They're seasoned business owners. They have a lot of things going on. They're starting to understand why we need to manage personal wealth and business wealth together and not separate or siloed or anything like that. And so today we're going to talk about succession, which is the last S. And this one is very important because this is the, kind of the end game. This is the so-and-so, or I should say, maybe like the quote unquote finish line for a lot of business owners. It could be the transition stage. It could be the closing of one chapter and the opening of the next. And that's specifically what I want to talk about. Because as the business owner, typically what happens is, especially for first generation business owners, and what I mean by that is you are somebody who founded the company or started the company, or maybe, you had a partner at some point and you kind of took over. Whatever it is, you're the first owner of the business and you're going to be selling it to a second generation owner, or you're going to be transitioning it to a management team, or you're going to transition it to a family member, or something of that nature. And they're going to be second generation, and we often call them the investor generation because they're going to look at the business as an investment, as to where you looked at the business as your baby, your cash cow, your paycheck, the job you gave yourself when you fired yourself from somebody else's job. And most importantly, what the business represents for the first generation owner is their identity. And a lot of times the identity gets wrapped up into what happens with the business, how they describe the business, how they talk about it to other people, how the business operates. And then when it comes time to think about succession, it's a very, very emotional time for that business owner. It's a very hard decision to process because it's the end or the coming end of an era. It's the day that you worked toward, but kind of never want to, you don't ever want it to come, because it means that you have to have some finality on something that has meant so much to you. And so the succession stage is the one that takes the most preparation. We would call this exit planning. And as you've heard me say in prior episodes, exit planning is not something that you do only at the very end of the path. Exit planning is something you do just to even get on the path. And that path can be 2 years, 5 years, 25 years. It doesn't really matter how long it is. Hopefully it's longer than 6 months, because you need time to prepare. You need time to prepare the business or prepare the asset. If we're looking at your business as an asset, you need time to prepare yourself mentally, emotionally, spiritually, physically, for what that new reality is going to look like. And you need to start defining it. So we're going to talk about the things that we do in the final S stage, the succession stage, because yes, there are some tax planning implications. There are some income planning implications. There are some investment planning implications, some retirement planning, estate planning. There's a lot of very important things that go around that. But very first thing that we have to start with when we're working in the succession stage is defining what you want for yourself. What does the next chapter look like for you? And what will be your purpose? And many business owners, as I was just describing, they struggle emotionally, very, very emotionally, after stepping away or even just thinking about the process of stepping away from a company that wants to find their identity, their daily focus, their purpose in life, their conversations at cocktail parties and networking events and Christmas dinners and things like that. And if you're going to think about a transition there, you have to have a clear sense of purpose, because if you don't have one, the whole process and getting into retirement and, all the things that you've worked for, all the, the money that you save for, or the business value that you've built that you've now been able to capture because the money's been wired to your bank account. If you don't have a purpose for what you're going to do next in your life, it's going to feel very aimless. It's going to feel kind of pointless. And it often leads to a lot of depression and health challenges and things like that. It's no different than somebody who retires after a very long career and then doesn't retire to something, which is why part of why at lifemoveswealth.com we have our clients write a statement of financial purpose. So that way we always know not only how we want to behave around money, but also what our purpose in life is going to be as it relates to money. Because yeah, you're going to have an income, and yes, you're going to be doing all the things with all your free time. And of course, the first couple of years, you just want to travel and hang out with the grandkids and do all those things. But you have to have a reason to get out of bed in the morning. You have to have something that is going to continue to drive you, because you can't be the kind of person, and it statistically doesn't work, who, from the age of 3 or 4, you had a purpose for getting out of bed and going throughout your day. And you do that all the way until your retirement. And then suddenly your brain decides that you don't have a purpose and it doesn't know what to do. And so that's why it creates a lot of issues for people. So we have to have a clear vision of what the next chapter looks like. No matter what that is. Mentoring, I see a lot of, especially executives who retire, they go into mentoring. They volunteer for SCORE so they can mentor other business owners. They are part of these legacy groups. Maybe they go to Rotary or Lions Club or Civitan or something like that. People travel, like I said, and they do all those things. And some people just want to retire and play golf, and that's fun too. But over time, the body can only do so much of those things. The brain can only do so much of those things, and it's going to seek out something that has a purpose. And so it's critical that we do this work. Now, there's some statistics around this. They're not really that, it's hard to find really strong statistics, but research from the University of Michigan and Rush University Medical Center, their research has shown that people with a sense of purpose are less likely to develop Alzheimer's and more likely to maintain independent daily function, which is very important, especially when you're in your 60s, 70s, and certainly if you are blessed enough to live in and through your 80s. Independent daily function is very critical for your health and your success and your ability to continue to live a quality of life that's even worth living. Now, we all know that women traditionally live about 5 or 6 on average years longer than men. But what we know to be true is that men typically struggle more psychologically transitioning out of their careers than women do, especially in situations where their identity has been very closely tied to their work. So this is a very important thing. And in fact, a lot of times when there's a business owner who would say, hey, I want to sell my business in X number of years, or I want to start thinking about transition, or we need to put together a plan for me to be worked out of this business. I very much want to start with, tell me why this is becoming important. Why is this the time? What are the factors that you're thinking about? What is it that you want to be doing? What is it that you're going to do next? What are you excited about as part of this? What will you miss the most as part of your daily routine? Um, is this the first time you've thought about making a transition? Has this been a lingering thought? I ask a lot of questions that kind of get into the human side of the decision, because it's too easy to work out the numbers side of the decision. That's all the stuff we have to do, and there's a process for that, and it's very involved and it takes a lot of time. But I want to understand what's happening between, the couple of inches between your ears and then the 6 to 8 inches between your head and your heart. Because if I don't understand those things, then we may put together the type of transition that works on paper, but doesn't work for you. And the Exit Planning Institute has a statistic that roughly 71 or so percent of business owners deeply regret transitioning out of their business a year after the transition happens. And that's simply because there's nothing there. There's no purpose. Nobody sat down with them and asked about how they felt, how they thought, what they were going to do for themselves. It was just like, here's this pile of money. Go live the life you've always wanted to live. Have fun. Enjoy yourself. You're not, no longer chained to the desk, all these things. But when you just start there, you ignore the fact that somebody is walking away from something that's meant so much for them, and it's a really big deal. And so we want to take care of the personal, the person behind the decision first. Once we have that figured out and we have some good clarity around what the next stage is going to look like and what are some of the things that you want to do from a purpose-driven standpoint, then we're going to start talking about numbers. And so where we're going to start is we're going to look at designing a tax-efficient exit strategy that's tailored to your specific business transition goals. So exiting your business is not just about the price you can get for the business, because the price is negotiable. There's all sorts of things behind it. You're going to have to maybe pay some things off, or, you're going to have a broker involved, and you're going to pay a success fee. And there's just going to be all these little tacky things that are going to come into play. But the price isn't as important as how much you actually get to keep after taxes. And so, yes, the price drives that, but there are some things that we can put in place to make that tax bill either efficient, or we can make it long-term deferred, or we can make it permanently non-existent, depending on the transfer method. And we want to be careful about how we capture capital gains. A great example is if you are the type of business owner and you have the type of business where an ESOP is ideal, then you as the business owner are able to defer your capital gains for a long period of time. And there's a process and ways that you do that to make that work. If your business is the right setup where you're going to do a Section 301 stock plan redemption, you can eliminate capital gains as you transition the business, which is insane. If you have the kind of situation where you have a buyer who wants you to go on to, or they want you to give them a promissory note or a seller carryback or seller financing or something like that, you get to defer some of the gains because you're only capturing gains as you receive the monthly payments or the quarterly payments or whatever your arrangement is. So there's a lot of ways that we want to think about how the tax planning is done. And it's very important, especially when we look at things like, hey, what's the value of the business? Are you going to be over the estate tax exclusion? And if so, how do we need to manage paying for taxes or pulling some of the value of your estate out of your estate and putting it into something that's irrevocable, so it's out of your control, which means there's no estate tax for you on that level of assets? We probably ought to talk about these things. And it's very, very important that the tax planning is a key part of what we do. Then, as a third step, we're going to look at ways, and this specific step here, which is maximize business valuation in preparation for sale or succession or liquidity event. Maximize business value. This says business valuation. Let's talk about it in terms of maximizing business value. That's why exit planning takes time. Because if you've been running your business for 30 years and you decide that it's now July and you want to sell your business by the end of the year, you've given yourself essentially 4.5 to 5 months to prepare your business for that transition. There may be things that we need to do that can take a couple of years for you to prepare the business well. Very simple things like how clean are your books? And if your books are a little messy or they're a little, you've done a little bit of commingling, you've got some personal expenses running through the business and things like that. Those kinds of things when your finances aren't in order, when your processes are kind of wonky, when you're running the business from your head and not from a system, that's going to drive down the value because a new owner is going to look at this and say, the books aren't clean. I don't understand how you run the business. I don't understand how you're holding on to your clients. I don't know how you talk to them. I don't know what the process is to bring in revenue. It's all in your head and not on paper. And so now we got to take time to prepare process documents. And that's work that there just simply isn't enough time to do for a buyer in their discovery period. And so they're going to be asking for information that you can't provide. If they only have 30 days for discovery, they're going to back out. And then you're going to have a hard time transitioning your business, or they're going to drive down your number to make it make sense to them to have to come in and kind of recreate the wheel or create the wheel, right? If there's a wheel that's rolling, but you'd have no idea how to stop it, how to speed it up, how to whatever. They're going to ask you to take less money. And so that puts your own financial goals at risk. So we need time to prepare the business for the transition. We need time to make sure that the management team and the employees understand that a transition is coming at some point in the future. We need to understand what their level of commitment to the business is. A lot of times when an owner says, hey, I'm thinking about a transition, here's the time frame, people bail and they go find other job opportunities. Or an employee might step up and say, hey, I'd like to buy this business. What do you want for? What does this look like? Well, we need time to prepare that individual too, if that's the way that you want to transition the business. And a lot of business owners really do want to take care of their people because they might own the business and they might have the most financial benefit overall from the business, but there are people along the way who have helped them build the value of the business. A lot of business owners are sensitive to that, and they want to take care of their employees. So giving us the time and the runway and the leadway of at least, I honestly, at least 2 years is ideal for planning a transition. It just takes a lot of time. We've got to take that 2 to 3 years, 5 years, whatever the time frame is. We need to set the business up so we can show a reduced owner dependency on that business to run. We need to strengthen the ability for the business to generate recurring revenue, to be able to show a pattern of recurring revenue. We need to document all processes in the business, and that's everything from how your widget comes in to how your widget goes out, and then how it reaches the end user and how the end user comes back for other things involving that widget or for additional widgets or whatever it is. Every step of that sales cycle and operation cycle and finance cycle and admin cycle and human resources or human capital, I guess is what we're calling it now. Whatever, all of those areas of the business, we need to document everything. So that way a buyer can walk in and say, this is very orderly. I understand your books. I understand this process. If I were a client, I can now understand how your business would interface with the need that you solve, the need that I have that you are able to solve. And so that also helps them then start to understand, okay, if I'm taking this over, how am I going to adjust marketing? Can I improve any of these processes that are already pretty good? Can I Think about the expenses that won't be in the business when the owner's out. We're going to add back owner related expenses. Does it cash flow well? Okay, this is very clear. If any of those things are messy, that's going to be problematic. So we have to maximize business value. We need time to prepare the asset. The next thing we're going to do is we're going to align post-exit wealth strategies for long-term financial independence. And once the business is sold, that's when the next chapter starts. And the comprehensive financial plan that we're going to begin implementing would have already been built and in place. So you don't start building the financial plan the day after you sell the business. As I've said a couple of episodes, a financial advisor's dream job is ring, ring. Hello, I just sold my business for $20 million. Can you manage the money? Well, heck yeah, I can manage the money. Get on down here and, here's the wire information. Let's open all these accounts and do all these things. No, that's not when you start your wealth management strategy. That's not when you start writing a financial plan. That's when you start implementing, because now the fuel, the money that you sold the business for, is now able to be deployed across the plan to make it go, right? So now the engine's fired up and now you can go down the road. Prior to that, because we've been preparing the asset, part of what we're doing also, right? So we've defined your purpose. We've helped you understand what life is going to look like post-exit. And then we start building the financial plan that includes the tax efficiency, that includes the business valuation, that includes the type of accounts and asset diversification that you're going to need or want. And we get all these things set up nicely. And then one day, finally, the transaction occurs, the documents are signed, the wire transfer hits your bank account from the title company. We then simply take that money and dump it into where it's supposed to go, and we start implementing the plan that's already in place. So it has to be done early. We don't want to do this after the fact, because if you wait until the wires hit your bank account and the next day you start looking up financial advisors, or that advisor that's been bugging you in all the networking meetings, or that's been prospecting you from a cold call list or something like that, you call them, it's already too late. They're already out of position to help you well. You've already missed an opportunity to do the tax planning. You've already missed the opportunity to think about and talk about the best ways to structure the tax plan and the exit plan and the transition method and where the money's going to go and who is going to take over the business and how do we make sure that the business continues after this owner. How do we know that they got the best possible sale price for the business? Did they get top dollar? Did they build value? And it's too late to answer those questions, because now you just have what you have, and that's the pile of money. So we need to align along the way what the exit's going to look like, and then build the personal financial plan so that way we immediately have something to start working on. We don't start building the day after the sale. Don't want to repeat myself on that because it sounds like I'm getting repetitive, but it's very, very important that we're doing this ahead of time, not after the transition happens. And then finally on this, the last part of the succession plan is we have to ensure that your financial freedom as the business owner extends beyond just the business ownership and into long-term retirement and legacy planning. And as I've said in prior episodes, the thing about a business asset for a lot of business owners, especially small business owners, is that business needs to have value that's transferable, meaning you need to be able to sell it for a profit or transition it to an employee for a profit or a third-party sale or take it to market if you're going to go public or something like that. You need to be able to have a profit because for a lot of business owners, the business is just like your 401k account. It's an illiquid asset that's building value that you need to be able to use in retirement at some point. And so a lot of business owners who don't have a 401k account have a business that they're going to use at some point later to fund their retirement. At least that's the hope. But transition, the statistics don't favor most small business owners. It's estimated that less than 30% of all businesses that have more than one employee will actually have a successful transition. Most of them will close. Many of them will liquidate assets. Uh, they just don't have the preparation needed to be able to transition that business well. Or a lot of them build businesses that just support their lifestyle, which is why they're called lifestyle businesses. And there is no transferable value because anybody else can just simply go create that on their own from scratch and build it themselves. Sometimes they'll be willing to buy your customer list or something like that, but it's really hard to do that. So think about, those kinds of businesses. I think about things like landscapers and pool cleaners and repair, maybe some appliance repair people, handymen, like those kinds of trades. Typically, they've built a business that supports the income that they need. And the only thing that they have to sell is a list of people that they've worked with or clients that, pay them monthly for trimming the trees or cutting the grass or cleaning the pool. And so that's not worth a lot. And for most people, that's not going to fund your retirement. So we have to think about what your financial planning and really your financial freedom after selling the business is really going to look like, because we have to think about things like, how do we make sure you don't run out of money? When do we take Medicare? Well, we take it at 65, right? But how do we do that? When do we take Social Security? Do we take it at 65 or 67, full retirement age, or 70? How much money is in any kind of other retirement type account? And do we need to plan for required minimum distributions? And what is that going to look like from a tax planning in retirement standpoint? And are you going to have enough money to fund your lifestyle, or do we need to make lifestyle adjustments, or do we need to sell an asset that's underutilized to provide a little bit more cushion, right? There's all these sorts of things that we need to think about. And then once we have the must-haves taken care of, then we start thinking about things like, what do you want to do? Do you want to be a charitable giver? Do you want to do that while you're living, or do you want to have that as part of your estate plan? What kind of philanthropic things do you have? If you're successful and you have a very successful exit where you have a lot of money to work with, do you want to be an investor for other business owners? Are there places where you can plug money into other businesses and just have that as passive income? So some business owners, myself included, would rather have passive income from another business than from a piece of real estate. Now that's may depend on your risk comfort, but that's a preference, and so maybe you have a little bit of both. We need to know that, and we need to have those discussions so that way we can say, here's the landscape of assets. Some of it's going to be invested in the money or the capital markets, I should say. Some of it might be in bank accounts as cash reserve. Some of it might be in real estate. Some of it might be in this business. Some of it might be in collectibles. Some of it might be, over here in currency trading. Some of it might be over here in commodity trading. Whatever that looks like, we can build that out for you and make sure that you take care of everything that's important. This is also a part, again, going back to the very first thing we talked about, taking care of the person, knowing the purpose, writing the financial purpose. Part of your legacy may include money to children or grandchildren, or to fund college, or a 501c3 that is very near and dear to your heart, or a civic organization that you've been a part of and you want to give to their foundation. So these are all things that are purpose-driven decisions that are included in your estate plan that are attached to your ability to have financial freedom. Because if you don't have financial freedom, none of those things matter, because you're just going to be worried about getting by, and you're just going to get by for as long as you live. The stress of that is going to get you into a position where you're probably going to get sick. And then it's going to be harder for you to fulfill your purpose. And then healthcare challenges come, and life ends, kind of short for some people that way. So we want to make sure that you're the best positioned for your retirement, for the transition of the business, for yourself financially, and for your family as part of your legacy. So those are the key components. Again, just one more time on each of those. We want to define what the next chapter looks like. We want to talk about purpose. We want to write purpose. We want to understand what you want for yourself and how you're going to go about doing that. Then we're going to look at all of the exit options that are available to you. We're going to figure out which ones make the most sense. Then we're going to start to develop based on what makes the most sense. We're going to start to look at the tax planning implications. Once we understand that, now we're going to look at maximizing business value over the time that you decide that you're ready to make a transition, or you think you're ready to make a transition. Until the transition date occurs, we need a couple of years to do the work to build and maximize business value. And so that's where we're going to get all the processes in place. We're going to reduce owner dependency. We're going to clean up the books. We're going to do all of these things that are important for dressing up, right? Preparing the business for that transition and for the right buyer to be attracted to it. Because as I've said before, as a part of this B.O.S.S method, nobody wants to buy your job. If you're the business owner, nobody wants your job. But they may be interested in the asset that you currently manage that may be a good investment for them. And so that's what we want to get to. Then we're going to align your post-exit wealth strategies for long-term financial independence. And that's going to parlay into ensuring that the financial freedom extends beyond you because you're going to have a family. You're going to want to leave a legacy. And we want to make sure that that legacy honors you while you're living and after you've passed on. So that's kind of the big wrap on the B.O.S.S method. Go back and listen to each of these 4 episodes on the topic. This is not your traditional wealth management and financial planning approach, especially if you're a business owner. I've said this in every episode over the past 4 that we've been doing the B.O.S.S series. I'm going to say it again. Business owners, the traditional wealth management platform is not built for you. It's built for the average investor, and you are not that. You don't have the same asset structure. You don't have the same risk tolerance. You don't have the same amount of money saved up just yet because a lot of it's wrapped into your business. We look at you differently at Life Moves Wealth Management because your situation is different from a lot of people. People who work a job, save to a 401k, have a house and cars and kids in college and all those things. They have a very different profile than somebody who has a business and a house and a car and kids in college and that kind of thing. And it's often because how the money is being saved for future use is very, very different. 401k, all capital market investments. The business is an illiquid asset that hopefully is building value beyond you, and we can reduce owner dependency so that way you can capture the value and use it in retirement just like you would any other retirement account. So as a business owner, we have to make sure that we're running your wealth management plan and your financial plan and your investment plan differently. We have to make sure that your personal financial plan is aligned with your business financial plan. Yes, your business needs to have a financial plan. Yes, you personally need to have a financial plan. Why? Because every decision that you're going to make as an adult has a financial implication. Why? Because you're going to have to continue to pay taxes until you die. Why? Because that's how our system's set up. Why? Because we need to make sure that you have financial stability and financial independence so you can be able to take care of yourself and your family and leave a good legacy. Why? Because that's what matters most to you. And having a financial plan on the personal side allows you to reduce dependency on what happens in the business. But we need to run a business financial plan so that it can build value and provide for you at some point the retirement capital that you're going to need to continue to live. So they have to be done together. They cannot be done siloed. You cannot have a financial advisor who only wants to manage a retirement account or a brokerage account and takes your word for what the business might be worth one day when it sells. And the financial advisor is very excited that you're a business owner because it means that you're going to sell your business one day and they're going to have a bunch more money to manage, which means the advisor gets a raise because they're going to be managing more money for a fee. That's wrong. That's problematic for business owners. We need to be preparing long before that, and the financial advisor needs to help you understand and build business value along the way, so that way that asset is being managed appropriately. So the B.O.S.S method it's designed to solve this typical challenge that business owners have, where they don't often have financial advice because they're typically not worth the advisor's time until the business is sold, or unless they've already inherited money, or unless they have actually done well saving and they have a big investment account. If you're the typical, small business owner with a couple of employees, and you're driving your revenue up past $1 million, maybe you're getting into the $5 million or $10 million range. Oftentimes, until you're 10 or above, you may not have the means to be worth a financial advisor's time. And so the B.O.S.S method is designed to solve that problem, fill the gap, gives you clarity, gives you control, gives you confidence that both sides of your finances are working together, business and personal. They're working together toward a common goal. And this isn't just another, as I've said, it's not another financial planning process. It's business owner specific. It puts you in control of your financial future. And if we do it right, we're going to be working together for a long period of time, because the process of financial planning doesn't really have an end goal. It has an ongoing taking care of your finances goal, because things are going to change. Every year the tax bill is going to look different. Every year your income is going to look different. Every year your investment accounts are going to look different. You might sell a house. You might buy a house. You might get married. You might get divorced. You might have a child. You might have a grandchild. You might want to send them to college. You might buy a car. Who knows what's going to happen? And that's why we do it all the time. So, we're halfway through the year, a little past halfway through the year. There's still time to get started and make 2025 a great jumping off year for 2026, or to finish this year strong. And if you're a business owner and you're not receiving financial advice, I'd love to talk to you. If you're a business owner and you have a financial advisor, but they're not talking about any of this, I especially would love to talk to you, because I bet you're being underserved. I'd love to help. So you can always send an email to info@lifemoveswealth.com. You can go to the website, lifemoveswealth.com, click the schedule with me button, which is at the bottom right of the website. And I'll be happy to meet with you. The consultation is free. There's no reason not to have a conversation. There's no reason not to get a second opinion on your situation. Worst case scenario, I don't help you. We don't work together, but I get you pointed in the right direction, give you some things that you can do as next steps. Or I might even, depending on the situation, be able to help you get to another financial advisor who you might like better, or that might be better suited for you. Or I might say, here's what you can do in the next year. Call me again and we'll do a review and see what's going on, reevaluate your needs. Best case scenario is it's a perfect fit. We start working together and your situation improves drastically over the next couple of years, as we are doing all this B.O.S.S method work to build the foundation, optimize your personal and business finances and cash flow, secure everything with the right planning in place, risk management, tax planning, cash flow, all of those things get wrapped into that business strategy, pricing strategy, all of these things. And then, of course, succession, beginning with the end in mind. What do you want for yourself? How do we get there? So that's what we're intending to do. So if that would be helpful to you, let's have a conversation. And until the next episode, go be a boss yourself. Have a great day. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.